Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Whether you're watching on YouTube or listening on any of the audio platforms, please be sure to hit that subscribe button. I have so many upcoming incredible guests that you will not want to miss. And speaking of incredible guests, this episode, the guest is Taylor. So Taylor, go ahead and give yourself an introduction.
Thanks for having me, Dividend Dave. I'm Taylor Sugar from the Wealth Playbook, and by day I'm a residential real estate broker, and I manage a real estate sales team that does luxury and rural properties. But in the nighttime, I spend my time obsessing about REITs and Bitcoin, and I'm sure that's what you are here to talk to me about. So I look forward to getting into that with you.
Definitely, yeah. As many of my viewers / listeners know, REITs are one of my favorite, probably my favorite sector. And I wouldn't say I have Bitcoin. I would say I have some Satoshis.
I think that's fair. And I think anyone who has one Satoshi has some Bitcoin. I think it's the...
So I think there's a huge difference between having 200,000 Satoshis and having 2 Bitcoin.
But I really appreciate you having me. And, I don't think a lot of people combine REITs and Bitcoin. And I think it's going to be...
definitely not.
I think it's going to be very popular in the future because, in the past, people would use bonds and equities to have income and growth, but that combination isn't working that well with the high inflation. And I think that REITs and Bitcoin actually replaced bonds and equities as a great combination of income and growth.
Oh, wow. That's a very interesting perspective. I can't wait to hear more about that take on how REITs and Bitcoin can be or maybe are somehow related. That's extremely interesting. So if you're listening or watching, definitely stick around to hear this, right?
And, it's funny because I have friends that love REITs and I have friends that love Bitcoin. And when I talk to my friends that love REITs about Bitcoin, they laugh at me and think I'm an alien. And when I talk to my friends that like Bitcoin, they're like, why am I wasting any of my capital in REITs? I should be all in on Bitcoin. But I think that, you want to have some diversification. And I think they work really well together. Maybe if we could pull up a slide, I can start to get into that a little bit.
Sure.
If you don't mind.
Before I do that, though, you mentioned in your intro about luxury properties and rural properties. And I just have to mention that I live in a very rural area. And to me, that is luxury.
I also live in Uxbridge in a rural area. And so I value rural property and I like that lifestyle.
Yes.
And I spend most of my day valuing residential property for the real estate business, and then I spend most of my night valuing REITs. So
Awesome.
I do the same thing in my day and in my night job, just a little different structure.
So again, for my American viewers and listeners, Uxbridge is what are you, about an hour and a half northeast of Toronto?
Yeah, maybe even an hour and 15, but not too far away. But
basically, Taylor and I were neighbors. From my location to his location is probably only about an hour and a half drive, give or take.
Well, that's nice to be with a neighbor.
Yeah, exactly. But yeah, let's get into this. I'm gonna bring up the, and again, awesome. Again, for viewers and listeners, Taylor has put some effort into this. He's went out and made an entire PowerPoint presentation. So definitely stick around to watch this. This is amazing.
And to give you my Wealth Playbook sort of project is a project between me and Drew McMartin, and we're trying to give. We don't have any qualifications and we can't say it's investment advice, but we try and give our thoughts on how to grow your investments in an inflationary world.
Right.
And we give all that information for free at our website. But to get into talking about how REITs and Bitcoin work together, I like to start with this barbell strategy image here. And what I'm doing is I'm taking, 80%, that's my target for my portfolio, and I'm putting it in REITs which are lower volatility, which generate a monthly income, which are easy to understand from a financial reporting perspective. And that's my conservative portion, right? That's my base. And then I'm also adding in a hyper aggressive component, which is the Bitcoin. And the REITs keep the Bitcoin grounded, right? Like your REITs are not going to have too much variability. Even if you have a recession or problems, the revenues and the profits are going to be relatively stable. Whereas the Bitcoin's not going to be stable. And so you're going to benefit from both volatility with the Bitcoin and low volatility with the REITs. And they don't have a very high correlation. So some days they're going up and down together, but a lot of the times they're doing the opposite. And that allows you to get that diversification. And when I look at how I structure it, I actually sort of have three positions. The first position is the REITs, the 80% REITs, and the second position is the 20% Bitcoin. But the third position is the leverage. And that position is, if I'm 40% leverage, I owe 40% dollars. So I'm short Canadian dollars effectively. And in this inflationary world, I want to be short dollars because the currencies are devaluing. But I want to do it in a safe way. And so the REITs, I have double the amount of REITs that I have in leverage. So the REITs service the leverage. They pay me the monthly dividend every month. And that dividend pays for the interest on the leverage. And there's still leftover, monthly dividends that I get to reinvest every month. And when I make that investment after I've paid that interest, I decide what is the best investment of that month. Is it a REIT? Is there a great deal on a REIT? Is it Bitcoin? Or do I want to pay back the leverage? And so this is sort of the structure of how it works. And what's interesting about this structure is eventually you're going to run into a Bitcoin bull market and the Bitcoin's going to get really good growth. And when it does, you can take that strategic opportunity to pay off your leverage and just end up with the REITs and the Bitcoin. And so again, I'm getting 80% income and I'm paying my 40% leverage, and then I'm reinvesting. And I think I'm getting the best of both worlds, where Bitcoin's offering me the best compound growth of the last decade, and REITs are offering me a reliable cash flow that is positively correlated with inflation.
This is amazing. You have thought this through. This is unreal.
Well, when you invited me to come on, I thought, like, I might as well just tell you what I'm doing because I think it's a good idea.
Yeah.
And other people might want to copy something that's similar to this.
Not financial advice.
Not financial advice. And I recommend for most people, if you're just getting into Bitcoin, you can start off with just 1% Bitcoin and learn about it. And
right.
I'm not saying go all in on it, but for me, this is a portfolio that I've been running since 2020. Basically, once COVID happened, I felt that the fiat system is devaluing currency too quickly, and that made me really desire Bitcoin.
Yeah, especially with inflation and, like you said, hyperinflation over this past year, that Bitcoin obviously does look attractive. And you did mention that eventually there will be another Bitcoin bull market. Maybe we should just explain sort of the Bitcoin halving and probably the probability of the run up of Bitcoin again, as that halving either comes close or when it happens. Odds are very good Bitcoin will reach those all-time highs again.
Yeah, and when I look at Bitcoin, I don't tend to focus on the price as much as some of the fundamental data. So obviously the price is very volatile, and it had a peak of whatever it was, 67,000, and it's
I think
pulled back
higher.
It pulled back dramatically from that point. But it has a lot of volatility because you're having this adoption happen worldwide, where you're having all this, the fiat financial system is slowly shifting into this Bitcoin system, and so it's going to be a little bit crazy.
And not just Bitcoin, all the cryptos, right? There's a lot of cryptos that are doing well.
Well, and I'm not. I'm only for the Bitcoin, but
you're Bitcoin maximalist.
Well, if I was a maximalist, I wouldn't buy REITs, but
Good point.
From the crypto perspective, I just stick with the Bitcoin. I think that Bitcoin's innovation is the decentralization And I don't think that that's been replicated. And I look at the fundamentals, like I was saying, like when I look at adoption, the number of Bitcoin addresses is increasing, the number of Bitcoin meetups is increasing, the hash rate is increasing. And so you can't look at Bitcoin like a traditional investment where you're going, hey, how many employees does it have? How much profit is it making? How much revenue is it making? You're not able to look at those traditional
definitely
metrics.
not.
So we have to sub in some other metrics like adoption and like the hash rate. And when I see the hash rate going to new highs, what I think that's a signal, it signals to me that investors and companies and maybe even governments are dedicating capital in the form of computer processors, in the form of warehouses, in the form of electricity to the Bitcoin network. So that is a very good sign of the fundamental growth of Bitcoin. And
Yes,
so with the hash rate going so high, I don't really, and the price low, I love that. I love the divergence between the fundamentals and the price. That just makes me want to buy more Bitcoin.
yeah. Yeah, so awesome.
I
Yeah,
will keep going for you. So when I don't have 20% Bitcoin right now, I mean, that's my target in my asset allocation, but everything's fluctuating all the time. So right now I'm holding 4 REITs and Bitcoin. So I'm pretty heavily concentrated. And
yeah.
I think that you found me from my position in Ryokan, where you're seeing my Ryokan fanboy tweets.
Yeah, I think we found each other through both of our Ryokan fanboy tweets because we both love Ryokan as our followers on Twitter know.
Yeah, and
And
for
actually,
me,
let's take a let's just take a second here to give ourselves a shout out on uh on Twitter. I'm going to share my screen so you can follow Taylor. I think that's come up on there. Oh no, I didn't. I failed. Give me 1 second. Sorry. You can follow Taylor
it's just at Taylor Sugar.
at Taylor Sugar. I think it came up there, right?
Yeah.
So there's Taylor's Twitter profile. If you want to give Taylor a follow at Taylor Sugar on Twitter. So, sorry, you go ahead and I'll get it back to your
Sure.
screen.
And I went all in onto Ryokan in May 2020 because when COVID happened, everyone thought, hey, germs are going to prevent retail from being successful. Retail is over. Ryokan crashed to $15, and I said, "Oh my God, this is a once in a decade opportunity."
What a
I
yeah,
borrowed it,
what a time to buy at 15, right? I think I
right.
started getting in around 18 or 19, like, and it was still like it's back down to sort of that 18 or 19 right now, but yeah, it's like
And I spent that month of May borrowing money from anyone who would lend me money to buy as much Ryokan as I could. I also bought smart centers at the same time, but I sold all the smart centers and I've kept all the Ryokan. But I bet you that I'll hold that position for a very long time.
oh yeah,
And I'll talk about why I think Ryokan is so valuable in a little while. But and you'll notice that I have pretty concentrated positions. And obviously, most investors would argue against that. They would argue for diversification. But when you're obsessed about it and you're following every little detail and you have a very good feel for the valuations and you understand the markets, I think you're better off taking concentrated bets and really monitoring them closely. So
yeah. A couple of points there. It's very, very, very easy to become over diversified, if you know what I mean. Like you're just trying to. You've heard, oh, don't put all your eggs in one basket, but so all of a sudden you're trying to put your eggs into every single basket. Well, that doesn't work either, right? Like you have to find that happy medium, draw a line somewhere.
especially when we're in such a difficult macroeconomic environment where we have rising interest rates, we have the potential of a recession, we have a lot of volatility. The motion of the ocean might be pretty rocky for the index funds and for the big portfolios. I'd rather focus on concentration and catalysts that are going to drive value even in the bear market.
Right.
And so, I'll switch into my framework, and I use quotation marks
Yeah.
because it's not very advanced, but this is sort of the mindset that I use when I'm picking my REITs on what am I looking for in a REIT that's going to make me want to take that concentrated position. And a lot of people, when they're just getting into REITs, they're going to focus just on the dividend. What's the dividend? Is it a good
Yeah, the
dividend?
yield, right? Like,
What's the
show me the
yield?
money. How much can I
Yeah.
make every month on this dividend, on this
And
REIT or whatever stock or share it might be? And they're looking at, I've fallen into that trap. I still do sometimes. It's like, oh, wow, look at that yield, like shiny silver, right?
And it's okay to have a high yield position if there's a good reason for it, or it's a fair value, or if you think the dividend is safe. But you can't really judge the REIT just on the yield. You have to look at other things. And so when I'm building my REIT portfolio, like the first thing that I'm focusing on is I do want to focus on building and growing that passive monthly income. So that's one variable where I'd like, when I'm making moves, I want to make my income go up. So that's, if I can, I will do that. The other thing I'm looking for is I want REITs to have a competitive advantage. They can't just be a portfolio of properties. They're a portfolio of properties plus a business model. And so I want to make sure that that business model has some sort of advantage that's going to let it drive value up and above what the sector would normally receive.
Let me ask you a quick question then.
Sure.
What is RioCan's what is RioCan's competitive advantage to smart centers?
Oh, this is a toxic debate, so I don't know if I want to get.
That's why I asked the question.
I've had this fight a few times on Twitter,
and nothing like a good old Twitter fight.
To go over, let me just start with RioCan's competitive advantage, and the smart centers business model is very similar, so they're going to have similar advantages. But when I look at RioCan, it's basically a retail portfolio that's delivering rent. And at the same time, it's leveraging the land that's under the retail portfolio to do development. And it can build at a lower cost and that's the competitive advantage. It can build at a lower cost than other competitors because it's already paid for the land. So it doesn't have to pay for the land to build new residential. It just builds on top. It densifies its existing positions. So that really gives it sort of like a lower cost of capital. It allows it to generate square footage with a lower cost than the competitors. The reason I like RioCan more than smart centers is I find that they're stronger with their rents. They're doing better at generating higher rents. And I believe that RioCan's portfolio is more urban than smart centers. And I prefer urban real estate because it has better pricing power in inflation. So, when I'm thinking about what real estate do I want that high density urban real estate to be able to keep the rents up with inflation rather than that suburban stuff. I still think smart centers is a good investment. It's just I'm all in on RioCan. I just think it has better fundamentals and it has a lower payout ratio. And what that's doing is it's able to self-fund its development, whereas smart centers is sort of using debt to fund development. RioCan is now using earnings.
Sorry, he's got to get his own FaceTime in every episode of the podcast.
That dog is very passionate about smart centers, and I know that he wanted to get his 2 cents in.
His vote was actually for RioCan, I'm pretty sure.
Oh, okay.
Sorry, as we go through this slide, next, buy discounted quality real estate with strong long-term fundamentals.
So I don't want to just buy cheap real estate. I want to buy real estate that's not expensive, that has a high value. So, I'm not just buying the cheapest per square foot or the highest yield. I'm trying to buy the best quality for the best value. The next idea is, you're trying to find the intersection of scarcity and demand. And, in this inflationary world, that's the way to win, is to find hard assets that are scarce. And that's like the premise of Bitcoin and also the premise of REITs. So that's why they're so similar, is that they have similar structure when you start to break it down.
I never thought of it that way before.
Well, listen, that's why you brought me here to give you the rundown.
Yeah, exactly.
And you can find scarcity. I used to invest in this REIT, Vici, earlier this year, and they basically own the Las Vegas Strip. Now that's some nice scarcity with demand, where you just own this strip. Or Ryokan, it has scarcity because, and you're going to see this in a slide that's coming up, no one is building retail at the current price. Like the construction cost of retail is very high. I can just zoom over there even. Let me, or I'll come back to it. But I think it costs $800 a square foot or something like that. They said on the earnings call to build retail, but Ryokan's retail is at $335. And so because they already own the land, they can build, and other people cannot. So they have that supply constraint scarcity, and then they have the demand because they're in Toronto, they're in these 6 major cities, and those cities are getting increased immigration. And so you got the demand, you've got the scarcity.
Well, and not just the major cities. Well, they're in cities like Kingston and wherever else, like the mid-sized cities as well, right? Which also makes them attractive because they're not just in Toronto and Vancouver and Calgary and Edmonton. They're also in the Kingstons and Londons and wherever else.
And I do think the majority of the portfolio is focused on the big 6 cities, but I hear what you're saying.
Yeah.
And I think that they've been delivering well. The other thing I think about is contrarian sectors. So I don't want to buy something just because it's out of favor, but if it's out of favor, I'm going to be more interested. And that's the concept of buying Ryokan when COVID came into play, or buying, we invested in Dream Office when people think office is dead, or, whatever the narrative is of the time. So I think that's a core tenet of value investing. You want to buy things that people don't like. And when I look at Bitcoin right now, Bitcoin is the perfect example. When the price was all-time high,
everybody wanted to buy it.
Everybody wanted it. My neighbors were knocking on my door to ask me about it. Everyone that I knew that I liked Bitcoin. They're coming to talk to me about it now. And that was at Bitcoin at, 65,000. Now Bitcoin is 20,000. I can barely get anyone to listen to me about it. If I mention it to somebody, they think that I've lost my mind.
It's so funny the way the human mind works. It's like right now you should be buying it, but people don't understand like how the halving works and how supply and demand is like. Supply is going to diminish and demand is either going to remain the same or increase. Well, when supply decreases and demand rises, that's basic grade 9 economics, right?
And we've been lucky to see a lot of these networks develop over our lifetimes. So when I was a kid, I saw Google IPO, and I saw that network, gain its network effect and grow and grow and grow and monetize. I saw Facebook launch, and at the very beginning it was just universities, and then it grew and spread to everyone. And you saw the internet go. I remember when it was dial-up internet, and I was begging my mom to buy it for me so I could have internet at home.
I never did ask you before we started recording what age group you're in, but you mentioned dial-up internet. So yeah, you're in the age range that remembers the.
Oh, and before the internet, I used to do. I would connect to my friend's computer directly. So I would, put in their phone number. My computer would call their computer, and we'd have like a direct connection.
Oh wow, you were a computer nerd too back in the day.
Oh yeah, definitely a geek. But once you experience, and back then the internet was complicated. It was hard to do. It was a niche thing. I had to I had to ask my professional parents, hey, I want it. This is why it costs this much per month. And then my parents said, oh my God, we have to get a new phone line. You're on it all the time. Like, this is ridiculous. But Bitcoin is very similar where, it seems complicated, but as it gets adopted, it'll go from a point of it's from the fringe all the way to it's on every app, it's on every device, it's part of the infrastructure of the world.
And when you say on every, that's a very interesting point, or actually it's become a question for me. When you say on every app, like, how 10 years ago or 15 years ago, a cell phone, you wouldn't really have any apps on. Now you buy a cell phone, it's got YouTube, it's got Twitter, it's got Facebook, Instagram, all the apps are just automatically loaded onto that phone. Do you think in 5 or 10, 15 years, there's going to just be a Bitcoin app where you just press Bitcoin and you can buy or sell Bitcoin right from that app on your phone, on it, whether it's Apple or Android or whatever?
I think that it'll be integrated. It's hard to know exactly how it'll be integrated, but, and I'll give you an example of my 4-year-old daughter. My 4-year-old daughter can pick up the iPad, find whatever show she wants on YouTube, figure it all out. She knows how to use it all. and it's just intuitive to her. And so, as she grows up, those younger generations, Bitcoin will be intuitive to them. It'll automatically be built into their lives, and it'll be simple enough. Like right now, it's a little bit complicated, but it'll be simple enough that it'll be like a one-click solution. And so it's exciting to see where Bitcoin is going. I don't think when the internet first came out, people could imagine Amazon, imagine all of these, value. Yeah. All the value creation.
And like all the social media platforms we just mentioned either, like, it sounds like you remember 1995, and in 1995, there was no way anybody was thinking that there was ever going to be such things as like YouTube, Facebook, Twitter, Instagram, and the list goes on, right?
Well, and when you look at those networks, like usually you have one winner, right? Whether like sort of how Amazon sort of beat eBay, for example, or Facebook beat MySpace, or right. And I think we've had a long enough time period since the beginning of Bitcoin to see that Bitcoin has sort of beaten out the majority of the other competitors. And I'm judging that by looking at the hash rate. So when I look at the hash rate of Bitcoin and I see it has the most powerful computer processing network in the world, and it's growing on an exponential basis, that is the green light signal of, hey, this network is here to stay. This is a protocol of transmitting value across the world, just like email is a protocol for emailing communication, and TCP/IP is a way of finding information and routing information and understanding where it is. This allows you to sort of communicate and send value over the internet, and so I think it's a natural progression, and I believe in it. Until the hash rate dies off or someone double spends Bitcoin, I will be buying.
Yeah. Sorry to get distracted from the slideshow presentation.
No problem. I'll finish off quickly here, but so when I'm looking at REITs too, you have to understand what the management, are they capable? Are they executing strategy? Are they aligned with shareholders? And this is definitely an issue with REITs because some managers are not aligned with the shareholders. So you have to be careful with that.
Yeah.
But if I think that the management team is executing strategy well and can drive and create that catalyst that can, gap us up from a discount to a premium value, that's going to make me more comfortable. And I would definitely prefer the management to be aligned with shareholders when possible. And the last thing, and this is important for now, is I want the business model to mitigate higher interest rates. So I don't want higher interest rates to be a deal killer. And I also want to see that they have a positive correlation to inflation, meaning that the rents can keep up with inflation or they're benefiting from inflation and that they're improving in their fundamentals. So I want to see occupancy rising. I want to see profitability increasing. Every REIT has different fundamentals, but if all of those things are in place and the price is low, it's a winning combination. It's a good idea. And talking about REITs a little bit, and these two charts are from a monthly report that I love called the CIBC Monthly REIT Report. And it's a great little guide that gives you a lot of information about REITs. And looking at it here, it shows us, basically the historical discount to net asset value. And we can see that REITs are at a 30% discount to value. They're almost as cheap as they were in the COVID crash, and they're almost as cheap as they were in the 2008 great financial crisis. So I like that in investing. Reversion to the mean is an important concept, and I think that offers a great risk reward. And then I look at the chart below that that's talking about price to FFO. So it's sort of talking about an earnings multiple. And, again, our earnings multiple on average here is 13 times earnings, with RioCan at 10 or 11. Nice. I'm really liking that. And I think a lot of the problems with the world, with the equity markets, is that things became overvalued and the multiples got too crazy. But the Canadian REITs are a very small, little, unique sector that's, it's sort of its own valuation metrics rather than comparing it to the S&P 500 or tech stocks or even US REITs. And I think that we're in a very favorable position right now. I think people should be buying REITs hand over fist.
Yeah, I agree with that.
Going into
not financial advice.
Not financial advice, yes.
Sorry, just going back to that last slide, you said that was CIBC.
CIBC monthly REITs,
So
and so
CIBC is Canadian Imperial Bank of Commerce, which many of my viewers and listeners know is one of the big five Canadian banks. I've talked extensively on the Canadian banks, so just wanted to sort of make that connection.
sure, and it's I would say my favorite monthly REIT publication. I think it's comprehensive and it covers a lot of information, and they really go all out in the research. So I think there's a lot of value there for people. I think it's free if you're a CIBC customer. Um, when I look at RioCan, getting into it
Let's
here,
look at
yes,
RioCan.
let's talk about it. And so a couple of things. I took a screenshot of one of my tweets about RioCan, and this is just talking about the Q3 earnings. And so, when we're looking at this, we're seeing, okay, they have 97.3% occupancy, and it's a little bit hard to see, but you know what? I can zoom. I can view
I
it
can see.
on the
Well, I can
fly.
see it, but
So, when COVID came in, there was obviously some challenges with operations because, the Canadian government restricted access to retail and different things. But
yeah,
RioCan is highlighted in these charts, the reopening. And when I look at like their retention ratios, the majority of the tenants are renewing leases, and they're renewing leases at higher rents. And so I look at the leasing spreads here, and they're quite good. We're talking about 9 or 10 or 8%. And historically, the leasing spreads have been better than CPI. And that's important because remember, I want to show that positive correlation to inflation. And so
yeah.
RioCan's rents are beating the CPI, which that's a good sign. And in the conference call for the earnings, I forgot who said it, but one said, today's leasing spreads are tomorrow's same property NOI, meaning that if we're getting good leasing spreads right now, we're probably going to see, improved profitability going forward for a while. Looking at that same property NOI, since the reopening, they've really been increasing rents, increasing the profitability of their portfolio, and I love to see that as well. And then they've been increasing the rent per square foot. So overall, their fundamentals are very strong. Where we're seeing higher rents, we're seeing higher leasing spreads, we're seeing good retention ratios. So
Low occupancy or
high
high
occupancy,
occupancy.
yeah, very high occupancy, record, I believe. So that's exciting. And the other thing that we can see is that when I think about RioCan, I think about it as it's almost like a money printer and a square footage printer. So it
Yeah,
prints money with the retail stores, and then it also prints completed square feet with the development program. So year to date, they've finished 393,000 square feet of real estate, whether mostly residential, and so it's paying you to hold it, and at the same time it's growing, and it has the lowest interest rate debt in the whole retail sector. So there's another reason why it's a little bit better than Smart Centers, is that they've leveraged ESG to be able to have a lower cost of capital than the other REITs, and their management is very smart. They have the second best payout ratio at 60%. And that's another big difference between Smart Centers is RioCan is paying out 60% of its earnings, but it's retaining 40%, and it's investing that 40% into the development program, getting higher returns than the market can get. And I think it has a decade runway here where it can build out that development pipeline for 10 years, and it's going to have a lower cost of development than all the other players because it already owns all the urban land. And that's why it's a great long-term hold.
yeah. Owning the land is a huge key factor, right?
And it's not just, you're not just buying land and banking on it. You're buying land and the retail is paying you while you're holding it, while you're building. So you get the best of RioCan is a good way of having your cake and eating it too. You get your income and you get your growth. And so
Yes.
you're getting your 5.5% yield or whatever it is, but you're also going to get some more yield. And that lays into my next slide really well. And this is my favorite image. This is the
Hey,
image.
just
Oh,
before we get into this
sure.
next slide, that last slide you used a whole bunch of letters. So for our some of our newer listeners or newer investors, uh, CPI, Consumer Price Index, And then what were a couple of the other acronyms or letters that you used there?
Sure. So we were talking about SPNOI, which is same property net operating income. So that's just talking about how much money are the properties that they had that were the same group of properties in the last quarter. How much money are those properties making this quarter, more or less? And when we're talking about FFO, that's funds from operations, and in the REIT world, that's sort of like the earnings of REITs. And so
Yeah.
When I dream about RioCan, and you know that you're into investing when you start dreaming about the REITs, and believe I'm not lying, I literally dream about REITs. I dream about this slide
You
because
dream about like RioCan and Bitcoin walking down the aisle together.
I do. I wake up and I make notes on my REITs on my little sideboard there. But when I look at it, this is a great way to understand. When I look at RioCan, and again, you're getting that 4 to 5% yield, and I think it's like 5.5 right now because the price is low. So you're getting that,
Yep.
but you're also getting that SPNOI, which means that they're paying you the 5%. They're growing the rent that portfolio of properties is giving you. So now you're talking about really like an 8% annual return. And then on top of that, you're getting that development pipeline earnings growth. And so that's how you are actually getting a 10 to 12% total unit holder return compared to
Right.
just a 5% distribution yield. And so not all dividend yields are alike. When you look, like another holding that I have is Dream Industrial, it offers a 6% yield, but that's it. And so,
Right.
this is there's a lot more depth to RioCan's earnings than just the dividend. And the market hasn't recognized that yet that well. And that's going to lead me into my next slide. And bear with me because this one is a little bit wild. But when I look at the history of RioCan
Sorry, I just
in the
brought up Dream there for a quick second.
no problem. And when I think about RioCan in the past, it was an income investment. And so what that means is the full yield was paid out to the shareholders, and that's all that it returned. It was just the dividend yield. But what happened is after COVID, they did a cut to their dividend. If you could go back to the slide for just one sec, I'll just want to show
Yep.
you where they did that cut. But so you can see back here, like 2008 to whatever it is, 2019 till the beginning of COVID, the majority of the return, which is that green area, is being sent back to the shareholders via dividends, where they're not retaining much earnings. This green area above the white line, I don't know if you can see my mouse, but is where they're retaining earnings. But they've shifted and they've cut the dividend. And I remember they cut the dividend on my son's at the hospital when my son was giving birth. So it would have been December 3rd of 2020. They cut the dividend. And when they did that, they didn't do that because they couldn't afford to pay the dividend. They did that because they wanted to use those earnings to fund the development pipeline. And this is where you have the big change, where they've shifted from an income investment to an income in growth. So before it was 90 to 100% income. Now it's like 68% income, 32% growth. And at the same time, they're growing the earnings. So they're investing that 32% of the money they're making, and they're investing it into their residential development pipeline, and they're getting great returns on that pipeline. And they're doing that because they're leveraging their land. And so you're going to see that continue to grow. And you can see this little the black line is the price, and the blue line is sort of the average earnings over time, or the average earnings multiple. When that black line is dropping low and that blue line is going up, that is that divergence that I'm looking for to identify a very good investment. And you can see what happened when COVID came in. That black line and the blue line are so far apart. That's what made me go all in right there. And we're experiencing a similar kind of situation now, where the prices don't reflect the real value of the investment. And I think that's a big opportunity.
Yeah, wow, that's an impressive way of looking at it. It's an impressive chart. Like just the line, like yeah, it really shows a lot when you're looking at these lines. Like obviously there's this big drop, which I'm guessing must be March. I don't think you can see my mouse either on the line,
Yeah.
but this big drop has to be March 2020, and then but going back to your point, income plus growth. It's like It seems like a perfect strategy. I'm getting my monthly income plus they're growing the company. It seems like such a no-brainer,
Which you
right?
want both, right? And that's, when we have CPI at 8 or 9%, it's, a REIT with a 5% yield is not going to cut it. You need, if you want to grow and have positive real returns, I think you're going to need double digit returns. And RioCan offers that 10 to 12%, and it's at a discount. So I really like it. And I don't think many companies are going to be able to replicate this business model. And I think it's going to continue to generate value. And over time, like they're going to be raising dividends now. So, their
Right.
plan is to have a sustainable dividend increase, and they're doing them in, I think, January. As the market sees RioCan raise its dividend consistently, and they see that 10 to 12%, they see that new growth, it's going to start to re-rate it. And,
Yeah.
historically, it might have been a 15 times FFO business. I think it's going to become an 18 times FFO business. And right now it's like a 10 or 11. And so
Yeah.
I like it.
There's a lot of room for growth.
Yeah. And I don't have many concerns about it. Like, I don't see weakness in its fundamentals, in its performance. I think Jonathan Gitlin has, been building this strategy for a long time at RioCan, been focusing on building this residential development pipeline. And I think it took 10 years for them to build up this pipeline and get everything zoned and get the human capital there that they're able to
Right.
execute. But now everything's there. They have the pipeline, they have everything zoned, they have the capital, they fund their own capital to do their own development. So I think this is a nice cash and condo printer, and I think it'll be giving me good returns for a long time.
So I just need to say that this episode of the Passive Income Podcast is not sponsored by RioCan.
No, no, they definitely. I have no affiliation.
It would be nice
But
if they just tossed us both an extra couple hundred shares or 1,000 shares for making this podcast, but rest assured that's not happening.
um, I'll switch gears a little bit and I'll talk about Dream Industrial.
Yes.
In the last 30 days, I've taken this huge position into Dream Industrial. I think I'm at 25% or something like that. So it's quite a big move. And what is motivating me with that is and this is a little chart here with the green arrows. It's looking at the performance from Q4 2020 till now and how things have changed. And so when we start looking at the grossable lease area, so basically how many millions of square feet does the REIT own, it's gone from 27 million to 46 million. And so it's grown its size
Yeah, that's a lot of
dramatically.
land, right?
Yeah, it's bought up a lot of property. It's scaled really well. And at the same time, it's pushed occupancies from 95% to 99%. And so,
Wow, even higher than RioCan.
right, so we have a really strong fundamental performance. And here, this is one that just blows my mind. I don't know how everyone isn't like talking about this, but they've lowered their interest rate from 2.5% or 2.57 down to 1.14, even though interest rates have been rising. And how
Yeah,
they've
how do you
done
do that? That
well,
sounds like a magic trick.
it is a magic trick, and that is the competitive advantage of Dream Industrial is they're using European debt. And so the
Oh,
European debt offers lower interest rates than North American. They estimated on their recent earnings call that gives them a 100 basis point advantage. But the debt, they secured the debt in the pandemic, and it's very low, and they have very low debt as well. So and at the bottom here, it talks about the net asset value and the unit price. Well, when I go back to Q4 2020, the net asset value was 12.55 and the price was 13.15. Not that great of a deal, and the occupancy is only 95. Today, the net asset value is $17 and the price is $11. And so you have amazing value, you have low prices, and you have high fundamentals, and that makes me buy a position.
yeah, of
And
course it does.
yeah, so the other thing that happened today,
Yeah, you see it
what
right there in the headline. Dream Industrial REIT announces the formation of Canadian Industrial Real Estate Joint Venture, and then the headline drifts
so
off.
that I mean, you had invited me to do the podcast before that happened today, but that made my day quite exciting. And what's happening there is a wealth fund from Singapore that's come in and they've bought Summit Industrial, which is another industrial REIT. And they did it as a joint venture with Dream Industrial, and Dream Industrial will be providing the property management, accounting services. That the Dream Industrial will be boots on the ground, and it's a very interesting joint venture that's going to increase the revenues for Dream Industrial because it's going to be getting property management fees on the full $5.9 billion or whatever it was portfolio. So it's going to be a positive thing that's going to develop over time, and I'm excited about that. The other thing that I look at with Dream Industrial, and this is my last, if you can go back to the slide, this is my last slide, so I'm almost done taking up all of your time here. But
no, you're the one that joined us, so thank you so much for spending the time with us.
No problem. One thing I'm thinking about with Dream Industrial is North American industrial, I think, is going to benefit a lot from the geopolitical conflicts that are in the world. So you have like war in Asia and Ukraine with Russia and different things. You've got an energy crisis in Europe. So you have a lot of higher risk levels in Europe and Asia where companies may not want to operate. And at the same time, they can go to North America and they can operate and they don't have to worry about energy or war of these things. And you also have a trend that's been, people have been talking about, like a deglobalization where, we're going to only work with our friends. So they're going to, instead of outsourcing to China, North America will use Mexico and Canada, and they'll use the NAFTA framework to have control over their supply chains. And I think that these concepts are going to actually increase the demand for industrial in North America. And so it's funny because people go, oh, the war is killing my investments, these things. Well, there's some things that benefit from it. And I think a North American industrial is one of those things. And I don't think it's a coincidence that Singapore is buying Canadian industrial real estate. It's doing that because it's saying, hey, I want some diversification away from Asia, away from Europe. Let's go and buy up a bunch of Canadian properties where they don't have too much trouble. And they paid, I think I read on Twitter, it was a 3.4% cap rate for it, which is, Dream Industrial is trading at like a 6 or a 7%. So I think that you're going to see more and more of these big institutions start buying up the REITs. Which is another good reason to buy them, because there's not many hard assets you can buy for a 35 or a 40% discount with improving fundamentals. Like if you went to go buy a building, a private building in Toronto, and it had 99% occupancy and amazing performance, and you said, hey, Mr. Owner, I want to pay you 35% below the market rate, no one's going to sell that to you. But you can do that in the public markets. Like it's amazing. This is the opportunity where the little guy who wants to just spend $20 buying one share has a better opportunity than the big guy who's spending $5.9 billion.
Right.
And has to pay a 20% premium to NAV, where you get to buy it for a 35% discount. And that's a 55% spread. And so I think why I love REITs and Bitcoin is that they work really well for the little guy, where, you don't have to be part of the club. You don't have to have a lot of money.
You don't need $1 billion to buy a few shares of RioCan or any of the other REITs that you've mentioned.
You don't need to get into a debt, right? You can just have passive cash flow from the REITs from day one.
Or even like I mentioned off the top, you don't need 20 or 60 grand to buy a full Bitcoin. You just need to buy a few Satoshis.
Well, and I think that, a lot of people, they don't like Bitcoin because of the volatility. They say, if I put money in Bitcoin, I'm going to lose it. It's up and down. It's gambling. But I think you can restructure that and turn the volatility into opportunity by taking the stability of the monthly dividends from the REITs and using that to dollar cost average into Bitcoin. And that's where the beauty is, where you're taking that stable passive cash flow and you're growing your SAT balance every month. So it's kind of like my REITs are my miners that are generating SATs.
Yeah.
But I don't have to worry about energy prices.
Yeah, that's an incredible way to look at it. I like your Bitcoin mining without spending an arm and a leg on your electric bill.
And I'm also not having to compete with countries who have a lower cost of capital or energy businesses that have a low cost of energy. I'm
or Bitcoin
still
mining with a volcano.
Exactly. I'm still investing in my circle of competence, which is real estate, and I'm using that to make my fiat mining to give me my dollar cost average into my satoshis.
Wow,
Uh,
that's absolutely incredible perspective, way of looking at things. I've never
well,
thought of it like that before and never would have. So thank you
well, and
for
that's why I
giving me
appreciate you
that
asking me to
idea.
come out. I had to tell you this because I've been trying to tell people, but I think it's easier in a video like this where we can talk about it rather than
Yeah.
me just trying to write blog posts. I think this is a really low risk way to approach Bitcoin. You
Yeah,
know,
definitely, because it's money that companies are paying you to not work for them. So you're just getting money literally to sit at home or go to your regular 9 to 5 or do what you do, and then every month they're just paying you money to not work for them. So it's a perfect way to find some extra money to go into whether you want to invest it into Bitcoin like you do or reinvest it into more REITs or into other whatever, right? Like that's the whole
yeah.
idea of dividend reinvestment.
And if Bitcoin is high, like when Bitcoin was super high, I wasn't buying a lot of Bitcoin every month. I was buying more REITs. So each
Yeah.
month I'm going to make an evaluation on what is the best return, what is the best value for my monthly dollar cost average. Sometimes it's REITs, but with Bitcoin at 20,000 where we are now, like it's almost Bitcoin every time.
Yeah. Yeah. Bitcoin is looking very attractive right now. Before we sign off, I just have a question for you. Obviously, you love REITs, and this is one that is one of my favorites. I'm just going to bring it up on the screen as well. Northwest Healthcare, NWH. I didn't see that anywhere in any of your slides or portfolios, but do you have any thoughts on NWH?
I have friends that invest in it. I'm not for or against, but I prefer industrial and retail sectors to healthcare right now. Um, but I'm not against it,
Yeah.
and it seems like it's low on its 52-week range, and
Yeah, it's
you
it's
know
on it's on sale. Actually, about 2 weeks ago, I got it even less than the $11. I was so happy. I was like, "Oh, I'm buying this on the fire sale."
Yeah, and I think it's right now it's hard to buy a bad investment in REITs because the whole sector is discounted so much.
Right.
So I think there's lots of opportunity. You could also just play the index. You could play XRE if you don't want to even think about it. That's
Yeah.
an easy way to do it. But I'm really attracted to the industrial and the retail sectors right now.
Yeah, fair enough. I do like NWH because it does cover both. Obviously, it is a REIT, but it does cover that healthcare sector, so it gives you some exposure to the healthcare sector. Obviously, as you know, I love RioCan just as much as you do. And I I've got a bunch of other REITs as well that good, bad, or indifferent. But like you said, you can't go too overly wrong on REITs right now. Not financial advice.
Well, and the nice thing is, like, a lot of people will want passive income in retirement. So when you're
Yeah,
buying the REITs, you don't necessarily ever have to sell them again. You can just have the dividend income for life. And when I'm trying to explain it to people, I say, plant a forest and then eat the apples. Don't burn the wood. You know.
yeah, that's a great saying. So another one, I haven't bought it yet. It's been on my watch list forever. It's called Chartwell, which their properties are more long term care and seniors housing. And I've always joked, oh, I need to buy that before I need to move into there. So that's just an
Not a
aside.
bad idea. You can pay your retirement rent.
Yeah, pay your rent with. Well, even that I've said that on other podcasts. Like, yeah, buy Bell, so Bell pays you pay, to pay them or
Or
buy.
buy Starbucks and have your coffee dividend.
Yeah, exactly. Anyways, thank you so much, Taylor. Again, at Taylor Sugar on Twitter. Go ahead and give yourself a shout out for anything you'd like. Do you have any
You
A
know,
website or a
I'm not monetizing in any way. I give all my stuff away for free. I don't sell anything. So I'm just happy to share the ideas. And I hope people that are smarter than I am can build on this REIT Bitcoin concept. And I'm sure they'll make products for it and it'll benefit people over time.
yeah, that's awesome. So thank you again so much for spending some of your time on the Passive Income Podcast. If you're still listening at this point, you have to subscribe. If you haven't noticed on YouTube now, the subscribe button is black. So go ahead and comment below. I clicked the black subscribe button. And yeah, thank you so much, Taylor, for joining us on this episode of the Passive Income Podcast.
My pleasure. And hopefully you'll have me again next quarter or whenever it's a good time for you. I'm happy to come back anytime.
Yeah, definitely. Thank you so much.
Have a good night. Thanks again.